Hey, what is going on to the AMC stock family? I know that the price of AMC is down. Don't worry, we'll be very briefly talking about that in just a second. But the main purpose of this video is going to be about a former Citadel worker and what he had to say about all these tricks and all these edges that hedge funds have compared to retail traders that still remain true till this day. So all these concepts, they still very much remain true till this day. And this is actually quite ironic, but it will make sense in just a few seconds. So this article states that good news for AMC. Disney to release the rest of 2021 films exclusively in the theaters. This piece right here says what this could mean for AMC investors. And then it says, while the movie is incredibly positive for AMC, there is a lot of work left to be done by the battered exhibitor. Revenue is still nowhere near these levels before, and there's no telling if it will ever be. This does further reduce the worst case scenario for AMC, and it continues to gain momentum. So this claim, it is increasing, the hedge funds are using it more, companies are using it more, and so are institutions. And quite honestly, even some paper hands. On a day like today, there's much more sadness going around, and that just creates some negative energy. Negative energy will make more people scared. We cannot have that in AMC stock family. So again, we have to be very resilient. And this article continues to say that still, in its second and most recent quarter, AMC lost $234 million in cash from operations. For now, the company takes another step forward. It remains to be seen how many steps will be needed to return to profitability on the bottom line. Remember, this is one of our favorite reopening plays because AMC can definitely return to profitability, and because they use the word return, that means that they were already profitable. So the only reason why they are not profitable right now are because of the current economic conditions. And so the good news is good news, and there is a reason AMC management and shareholders to cheer. So that's why we should be happy, because they can definitely return back to profitability, but right now that's just not going to be the case. But that's not what we're going to talk about. We're going to talk about this point right here. AMC lost $234 million in cash from operations. This is exactly what Citadel and these other hedge funds they're going to use to support their own claims, and here's why. Okay, so hopefully you've been following along this far, because now it gets even more important. This says that the AMC Entertainment short interest ratio and short volume. No, we're not going to be talking about all this. We did talk about previously, and this has actually changed though very quickly. So it changed versus the previous month of the short interest up 3.81%. It was actually higher, so that is good news. But wait a minute, the August 31st short interest over time, that actually increased quite a lot. I actually did not notice that. So that's actually quite interesting, but again, no reason to panic, no reason to worry. The more short interest there is, the higher the probability of another short squeeze 2.0, and the higher the probability of a mother of all short squeezes. Now let's go back to Citadel. So over here, we have the institutional investors shorting AMC Entertainment. And from this, on August 17th, the reporting date, Citadel Advisors LLC, this company, reported a 48.1% increase in their amount of selling position towards AMC. And over here, this is the position size. So right under $500,000, Citadel is going to do what they can to try to get these negative catalysts and try to persuade others to think that AMC is in a bad fundamental position. If you have this much of a selling position, almost 50% increase from your previous position, any type of bad news is going to support your own claim. And in this case, Citadel is betting that AMC is going to go down in share price, or in other words, that is their market claim right now. So why would they not be in favor of that type of negative catalyst where AMC's balance sheet is not the best? And that is exactly what the previous article was talking about that estimated $200 million that AMC is currently underwater in. And I'm not going to talk about the chart too much because we have to talk about the interview. After all, that was the main purpose of this video. But really quickly, if you guys are wondering what my opinion was, and remember, I'm not a financial advisor, but quite honestly, I've been saying this so much on the channel, and some of you guys in the comment section, you guys have been doing so well. I'm so happy that you guys have been getting some insights out of these videos because you guys know how to trade AMC. We've been talking about the correlation between Tesla and AMC specifically. On a day that Tesla is down, which was yesterday, remember, Tesla yesterday went all the way to $708. Don't be fooled by this green candle because this actually has an insane wick to the downside. And so on that day though, look at AMC. Barely down on the day. In fact, there's actually a candle wick moving towards the upside. That's how insane, and that's how much of a difference there was. However, on a day like today though, make no mistake, AMC can go down, and sometimes it will. That's just inevitability, and this actually is going to prepare AMC for another leg up. But we're not going to get too much into the technicals and why I believe AMC is still going to go up in the future. But now let's compare this to Tesla. So Tesla on the day, look at this, had a wick going to the upside, not the downside, and there was no red candle. It was still green, and not only that, but as I just mentioned, there's definitely a wick going to the upside, and this actually went to almost $755 a share on a day like today, whereas AMC dropped a couple points. Now remember, there's no reason to panic. We buy, we hold, we support the movement. Now here's a former worker of Citadel, and this is going to be the interview that he had with CNBC, and if you listen throughout the majority of the interview, you will hear how he says that Citadel and a lot of these hedge funds, they do have an upper edge, and they will use all these tricks, all these tactics, because that will allow them to have the next leg up compared to the retail traders.
Is broken, and retail traders are getting a raw deal. Let's bring in Dave Lauer. He's He's a former high-frequency trader at Citadel. He is now CEO of Irvin AI. Dave, great to have you with us.
Thank you so much, Melissa, for having me on. It's a real treat.
Why a raw deal? What about the deal is raw?
I think there's a lot about our current market structure that's overly complex. And if you ask any regulator, they will tell you that this is not the market structure you would design if you were starting from scratch. And it's something that's been layered on year after year and decade after decade. And frankly, the point that we've gotten to is one in which a lot of incumbents have been able to structure it exactly how they want it to be structured because they're making a lot of money and they are able to wield a lot of political power. And I think we've really lost sight of the two primary purposes for markets, which is price discovery and capital formation. And price discovery is so critical that happens mainly on stock exchanges, on lit markets. So this issue that you just brought up with half of all trading taking place off of exchange and up 70% or more in stocks like GameStop and AMC, I think is a real problem, and it's costing everyone money. It's costing the retail investors money who are trading through their brokers and all of whom's orders are being sent to people like Citadel and Virtu, but it's costing pension plans and mutual funds money because they're the ones trading off of the exchange quote. And if that quote is wider because of all this off-exchange trading taking place, and by some estimates, 25% or more is how much wider the spread is than if all of those retail orders were to make it to the exchange. So if they're trading against a wider spread that's 25% too wide or artificially widened, that's costing pension plans money. That's costing mutual fund companies money. That's where retail truly has all of its wealth. And I think that's a big problem.
So they're getting a raw deal because they have to pay more under this current antiquated system that was built by incumbents, you say?
Yeah, that's right. And when you have the internalizers in a de facto duopoly, you have other issues around corporate concentration of power and antitrust. And Gary Gensler has said exactly that in his SEC testimony, or in his congressional testimony when he was becoming the SEC chair, and in his first testimony. You know, this is an issue that I think is going to get a lot of attention, and I think that concentration of information is also problematic, right? If 70% of GameStop is trading through Citadel and Virtu, and they're also making markets on exchange, and they're the designated market maker on the NYSE, for example, they have a huge information advantage. And that kind of information advantage means that they have a lot of power to set the price of that stock. Now, it doesn't mean that they're affirmatively manipulating it. I'm not saying that, but it does mean that they have a lot of power and they can swing it, in all sorts of ways to help improve their profitability or change the quote at which they're then internalizing.
Hey, David, it's Jeff Mills here. Quick question for you. You know, obviously the SEC regulation cycle is very long. We're shining a light here on some issues that impact retail traders. Is there anything that they can actually do today to better position themselves for the environment in which they're operating?
You're asking in terms of what should regulators be doing?
What retail traders can do right now? Like, are there any actionable insights that they can take away from this discussion other than the idea that, yes, they are disadvantaged, but is there anything they can do to better position themselves given the present circumstances?
I think so. And I think that they can take a good, long, hard look at their broker. And how does their broker handle their orders? Now, if you're a retail trader, it is very difficult to get away from a broker who is sending their orders to this duopoly of internalizers. However, when the retail broker sends their order to an internalizer, the internalizer has a certain amount of profit that they're going to make, and then they have a certain amount of money that they can rebate back to either the broker or the retail client. So if they send it back to the broker, that's payment for order flow. If they send it back to the client, that's price improvement. They get a better price on their execution. Some brokers take nearly all of it as payment for order flow. Other brokers don't take any payment for order flow. They just give it all back to their client as price improvement. So if you're a retail investor, you can say, well, I probably want to go with the broker who gives me everything in price improvement. That's going to add up over time. And it does get to another issue that I think regulators need to address, which is best execution. And are these retail investors really getting best execution if you're measuring it against an artificially widened spread, and it's okay for some brokers to take everything in payment while others are giving everything in price improvement. I can't see how those things can possibly both be best execution. But the problem is, if you ask a regulator, they will tell you, and this is a direct quote, that trying to enforce best execution is like trying to nail Jell-O to a wall. And I think that's a real problem for markets.